Katie Murray, RBS CFO, thank you so much for joining us on Bloomberg TV. So it's the start of a new strategy, new name, NatWest Group. What's the plan for NatWest Markets?
NatWest Markets. So you'll be familiar with our results in NatWest Markets. We started this business, a number of years ago. The last 4 years have been a journey of transition. And what we got to was actually to realise that actually what we were building wasn't the right thing for the economy that we had today. So when Alison came in, we kicked off a strategic review and looked very much to say, well, look, of the product lines, what makes sense? So we've announced today that we're going to halve the business by RWAs and looking very much at reducing within the rates business. We've got a very strong currency, a very strong financing business, but it's the rate business which is quite volatile in terms of its returns and also absorbs a lot of capital. And in reality, it's not the closest business to our corporate customers. So what we're really trying to do is to make sure our corporate customers and institutional are very connected in the business lines that we're really best at operating in.
Is this a step that's moving towards eventually actually carving off NatWest Markets from the business, selling it?
Not at all. No, it couldn't be further from the truth. In fact, as we look at it, those currency financing lines, they're really important. A lot of our corporates also use a small bits of the rates business. You know that we're the biggest lender to business in the UK, and actually the product lines that we have within NatWest Markets are really important for us to be able to maintain that position, and also for our customers to be able to do the business that they need to do. So very connected, very strategically important for us as we move forward. But we need to reshape it for the business for the future.
Does reshaping mean job cuts in NatWest Markets in 2020?
We always have a policy of talking to our staff about job cuts, but the reality is as we shrink the rates business, there'll clearly be some impacts within NatWest Markets.
What about cost cutting more broadly through the business? How's that going to look in 2020?
We've had a great year of cost cutting. We've took 310 million out against a 300 million target. And in RBS, we've got such a strong history of that people expect us to take 4% of our cost base out every year. And that next year will be one of the same. 250 million is the target for next year. I think it's just below the 4% number. But as your big number shrinks, the percentages obviously get a bit smaller. But challenging targets as well as we move into next year. And we need to continue that for a number of years, just in terms of continuing to reshape the cost base as our customers change and the way that we all do business change as well. Much more investment in the digital and technology that we're all using every day, much more and more.
What levers do you have to pull to actually work on the net interest margin attrition?
So as you look at the net interest margin, and it's the thing I know today I'll talk a lot about, the reality of net interest margin is, it's really much to do with the yield curve. We're in such a low rate environment, and that is what's coming through in our mortgage pricing, and it's very much been driven by the mortgage pricing. So in terms of the attrition, you have to think, well, actually this book used to be much more valuable, earned probably 1.6% in terms of what you were kind of trading at, and now the average of the book is 145 basis points. So it's repricing down to these lower levels. So the NIM is important. I get a little bit frustrated that people focus on the NIM so much, because actually what's really important is the return on equity we get on this business. So today the mortgages we write earn above 20%. Even with the new inflation that we'll see coming through in RWAs at the end of the year, they're comfortably above 15%. I'm delighted in that business that they've really managed to ratchet up volume without impacting risk. And the volume is now kind of replacing the lost income through margin. So while the margin reduction is a feature, actually the strong volume growth and the strong ROE makes it a great business for us to continue to be participating in as we are.
Okay, well, let's talk about those two things. I mean, the volume growth, for a start, you've said today that you continue to see challenges for income in 2020. So how far up the risk curve are you willing to go to actually grow income?
We're very, very clear that we don't want to go up the risk curve to grow income. If I look at mortgages, we did 10.4 billion new mortgages in Q4. That is a staggering number. It was 15% market share. If you think that our stock share is only 10%, the fact that we're managing to sell and actually be able to process and make sure we've got the right kind of customer engagement at 15%. And it's really because of what the team has done in terms of engagement, making it so much more digitally able. So, I think for me, the mortgage piece and the risk curve, I wouldn't look at it like that. But when I do look at 2020 challenges in terms of income...
Yeah, how do you look at the challenge in income?
No. So if we look at 2020, it's less about mortgages. I think people often go there. It's very much about... there's some regulatory changes coming. We think that they will have impacts on our numbers, about 200 million a year. As we look at the high cost of credit, we're clearly going to incur some losses in terms of the resizing of NatWest Markets. And the yield curve is still going in this direction, and we, in our own economics, in our base case, are anticipating that we'll have another yield curve cut. Those things all make make income harder, particularly for banks.
Oh, you're factoring in a rate cut from the Bank of England?
We are, yes.
Right.
We mean in our model, it will be wrong, but we have it coming in from Q2.
Okay. On the return on tangible equity then, you're targeting 9 to 11% in the medium term. This is down from 12%. What's the rationale there?
You'll recall that we walked away from the 12% in June last year, and it really was a conversation around the economics. You know, as you look at what we're doing with NatWest Markets, we're going to resize it to the right business as it goes forward. And actually, as we make those changes, what we feel is in the medium to longer term, 9 to 11% is the right return that this business should be earning.
Mm-hmm. On the CET1 ratio as well, the capital, 13 to 14%, do you still have the same plan in place with Alison Rose as CEO to run down that capital?
Oh, no, absolutely. I mean, it's something that's very important for us. It's important for the economics of the bank. It's important for the shareholders. Our initial target is to get to 14% by the end of 2021. You'll have seen that today we announced further dividends, an extra 3p ordinary and a 5p special. That means we'll have paid out £2.7 billion this year in capital, you know, which is a huge kind of payout in any 1 year. It's 170% dividend coverage, so a really strong payout. But we are very committed to getting down to the 14%. But with the 13 to 14% guidance, what we wanted to make sure the market understood is 14% is not the end. You know, over the medium term to longer term, we will continue to go below 14%.
Mm-hmm. A new government in place, of course, and we had some reshuffle of the cabinet yesterday as well. In this environment, are you more optimistic about share buyback?
Look, I'd let your view and your viewers kind of take your own conclusions, but what we would observe is that with the majority that the government has, what you can see is a period of time where we have relative stability in government, not necessarily in the ins and outs of the office. So that it makes an environment that's good for the government to do directed buybacks. They've been very open throughout the time that they wanted to participate in a directed buyback. We've always been very open that we would be very eager to participate in it as well. So it feels that this could be the start of a multi-year process of buybacks, and let's see how it develops.
Multi-year, so this year.
Yeah,
no possibility?
I mean, I would certainly say that we at the moment, you know, it's one of the questions obviously for the UKGI more than for us, but given the way government is sitting, it feels that this year should be a possibility. We'll see how the year develops.
As part of this strategy review for 2020 as well, a significant part of it is some changes that you've outlined in terms of climate goals. What have you decided there?
No, I think for all of us, you know, climate is the big kind of existential threat. You only need to turn on the television to see that. What we have said is around that we're going to work to basically half the carbon emissions of our balance sheet. Now, the reality is it's absolutely the right ambition. We believe, you know, as RBS, we're already leading in so many fronts, being the largest lender to renewables. We've got some of the strictest co-investing policies already. And what we need to do is to work with the UK economy as it transitions to this new carbon world. I'd love to be able to tell you that this bit of the balance sheet had this value or that, but the thing is that myself and all the other investing institutions need to work through that in the next couple of years so we can get credible measurement so we know that we're taking the right actions. But what I know and I'm very confident about is that Alison and I are building from a very strong base.
Yeah, I mean, we've had comments from a number of central bankers, including Mark Carney, saying that climate change poses a risk to financial stability. How, as a bank in the UK, can you mitigate against that?
It's really about working with our customers to help them transition, making sure that they're understanding what others have done, what they could do, and then making sure we bring them the right products. So from a banking perspective, it's also a great area of opportunity.